Welcome back. Let's get straight to the business of infrastructure financing via pension funds. Now, the new PENCOM guidelines stipulates a total of 20% threshold for PFAs to invest via bonds and cash. To talk more on this, I'm being joined by the Regional Director, West Africa Infrastructure Investment Managers Limited, Shola Lawson. Good morning, Shola. Thank you so much for coming in.
Thank you.
So let's take it off from the new rules
Sure.
by PFA. What do you think about this draft regulations for PFAs and other investors in infrastructure?
Well, first, if you look at the infrastructure deficit in this country, we're running at roughly $10 billion a year. We need about $100 billion to meet the gap. If you look at where the crude oil prices are today, $60 per barrel, clearly you're going to need some private sector participation in the infrastructure sector. So pension fund assets have to be used to progress. Now, if you look at what PENCOM have done, they've said pension funds can invest up to 5% in infrastructure funds, such as ours. We're a registered infrastructure fund manager, and then another 15 to 20% in infrastructure bonds. Now, the experience you've seen in other emerging markets, in other global markets, if you look at the US, if you look at Canada, if you look at Australia, is that pension funds have been the natural home for infrastructure assets because they have long-term liabilities, and therefore they need long-term assets to match those liabilities. And especially when you add the inflation-linked nature of such assets, it's clear that the pension funds have to get involved. So absolutely, it's the right step. I mean, these guidelines have been in existence since 2011, when they were released by PENCOM. What you've seen now is that the limits have been revised upwards somewhat. So you've gone from what was a blanket 5% for infrastructure funds to now a range of 5 to 10%, depending on the type of fund, and then a range of 15 to 20% for infrastructure debt, depending on the type of fund within the pension fund.
But now, looking at an economy like ours, and you already mentioned, you said the UK and Canada, for instance, have already started such investment financing. But their economies are not kind of like ours. So let's look for a country. Let's talk about an economy that is somewhat like Nigeria's, and how best they've been able to manage such investment financing using, the pension funds.
Well, firstly, I mean, clearly developed economies and emerging markets are different. But if you look at other emerging markets like Mexico, where the federal or the government enforced, they had a limit for pension funds, which was something like 10% of assets under allocation for both equity and debt. So I mean, there's a clear precedent that's been set. It's not a question of different economies. It's more, how do we make sure that the pension funds who are going into these assets really understand the risks, the first thing, and how do we make sure that they're not just doing any projects that they want to do, but projects which will actually safeguard contributions funds. Now, that's one of the noticeable things that the PENCOM guidelines has done. So, for example, if we talk about infrastructure bonds, you're only allowed to go into a certain type of bond, which is single A rated, which has federal government guarantees, which is Infrastructure Regulatory Commission approved. And for infrastructure managers, you can only go into a fund manager who has a long track record and who has been doing this thing. As it stands, there's only 2 infrastructure fund managers registered in this country. We're one of them. And there's nothing by way of infrastructure bonds which currently exist in this country. I mean, the way it normally works is that you need the equity part of the equation to work, because equity guys are sponsors and the developers, and then you normally have the debt guys coming in once you've actually created a market for these projects.
Now, in terms of looking at investments, now do you favor infrastructure investment via public-private partnerships or joint ventures?
Well, I mean, I guess you can do both under the same umbrella. I mean,
and not have any conflict of interest?
No. So in terms of public-private partnerships, if you take a toll road, for example, you will have the partnership with the government, where the government is the implementing authority, such as the Lekki Expressway, or where you have a power plant where the government actually buys your power, so the government is an off-taker. So that can be classed as a sort of PPP, but you're in a joint venture because you're not just going to have one equity investor or one lender. You're going to have a whole range of consortium members who come together to try and finance the asset.
So that's what we should be focusing on with this particular new company.
Absolutely. So I think, I mean, in terms of where the pension funds should be looking at, firstly, they should be looking at credible infrastructure fund managers, and they should, on the back of creating projects, you then have the ability to issue bonds, and the types of projects they should be doing, or the types of projects that we're looking at, are, for example, power plants, where you have a federal government guarantee behind your offtake agreement, and also other critical infrastructure such as gas processing and pipelines, where you have long-term contracted offtakes with credit-worthy counterparties.
Yeah, because a lot of people actually feel that there should be more direct investment, direct investing instead.
By the pension funds?
Yes.
The issue with that is they're not experts. So for a pension fund to invest directly in a company which is not listed, so a private company, carries all sorts of risks. And if you look at, again, sorry to go back to developed markets, but the way things have progressed are that initially the pension funds have started off going through pension fund managers, and then subsequently, once they've built up the internal expertise, they then have the ability to go direct. So I think PenCom is absolutely right, not allowing pension funds to go directly into these assets at the moment because of the risks.
Yeah, and I was also going to ask, do you think that they have, you know, the experience or the know-how to do analysis and due diligence, which is actually required for infrastructure financing?
The answer is, at this moment, probably not. But, you know, once the market gets built up, once more deals have been done, once they've sat on investment committees for funds, etc., then they build up the capacity within their organizations.
When you say building up capacity, what duration are we looking at? What's the timeline that we're looking at? Because you see, this has been in the works for a very long time. Sure. The conversation has been on with regards using, you know, this pension funds to begin to finance infrastructure. So it's not something that just, you know, started today. Sure. It's something that's been on. So for how long does a company need to, you know, work with projects or work with managers such as yourself to get themselves to that level where they can, on their own, do due diligence and probably, you know, analysis on projects?
Well, it's a very good question, and I wish I knew the answer. But I think it's going to take a while. I mean, we've been talking to pension funds for the last 4 years, and some of the pension funds have really recently gone into one of the infrastructure funds that's available in this country. Now, in terms of seeing all the pension funds at their sector limits, 5% for equity, 15-20% for bonds, you know, that's going to take you know, quite a period of time for them to get to those levels.
Well, prior to working at Macquarie, you worked with PricewaterhouseCoopers
Correct.
London, and you focus on transaction advisory services.
Correct.
Do we have a lot of that now, especially with this in the works, infrastructure financing now, using pension funds, with this in the works? Do we have enough advisory services for companies that are interested?
I think it's again a market that has developed a lot in the last 4 to 5 years, and there's a lot of high quality institutions providing advisory both on the equity and the debt side. So if you look at the advice that the government receives, that's equally important. So it's not just project sponsors or promoters or lenders. The government also needs advisory such that projects are properly prepared and properly structured before they come to market. And you know, there's been some support given by some of the multilaterals in terms of financing feasibility studies and that sort of stuff. But we probably need a lot more of that to get to a critical mass of projects coming to the market.
Now let's take a closer look at the debt markets as well. It's also very critical in, you know, financing of infrastructure. Sure. But in what aspects do you think that PFAs can really, you know, utilize it, such as as a building block to get into where they want to get to?
I mean, firstly, on the debt side, it's an instrument that PFAs understand. They're heavily invested in corporate bonds and federal government bonds. So the sort of fixed income-like nature of those investments are something that can readily transfer to the infrastructure side. The issue is that there are not enough projects, firstly, and then secondly, there are no projects with infrastructure bonds, not to talk of infrastructure bonds that are rated single A. So it's going to take some time to develop the critical mass of projects before they can start investing in.
But why do we always have issues with that? Why do we have issues right now with infrastructure bond? It's such an interesting bond to actually buy into, but not a lot of people are keen on it.
Well, there's nothing offered. So I think you need. I mean, what's happened in the last 4 years? There's been a number of privatizations of some of the PHCN power companies, yes. And there are a number of greenfield power companies which are currently being developed. Now, for a bond to be issued, probably at a single A rating, projects need to be up and running, generating cash flow, and profitable. Now, for the PHCN assets, that's just beginning to happen now. And then for the new assets, that's going to take 2 years to actually build the power plants before you start generating power and then generating cash.
So it also now makes you wonder why anybody would want to tie funds down on a project that might not begin to yield cash anytime soon. We're looking in the short to medium term, 3 to 5 years. Yep. So it's like tying your money down on a project that might not just begin to give you cash as quickly as you want.
Yeah, no, I mean, it's a very good point, because that's one of the key considerations and one of the key objections that pension funds have had to investing in infrastructure, which is that it's going to take you 3 years to build it. By that time, my competitors could have been realizing gains on the stock market, etc. But the point is that pension funds have to build a portfolio. So you have short-term liabilities, medium-term, and long-term. In terms of matching your short-term liabilities, nobody's telling you to go into infrastructure. Go into liquid investments, stuff that you can trade in and out easily. But in terms of matching a 15-year to 20-year liability, you need to go long on your asset side to be able to match.
So let's talk about short-term liabilities that sure. PFAs can begin to look into at this time.
For infrastructure?
Yes.
They don't exist because it's a luxury asset. So for short-term liabilities, they should go into some of the more liquid other securities, money market instruments, federal government bonds. But for infrastructure, they should be focusing on long-term financing.
All right, we'll take a quick break. We'll catch our breath and come back and continue this conversation. Shola Lawson will still be here with me when I return in just a moment, and we'll focus on the state of infrastructure and current levels of private sector investment. Please join us again.